Hello. So today I'm going to talk about the fat tail, risk of fat tail, and it's often talked about in the field of finance in various areas of finance. And if I've ever done investment and you have studied about investment or you have done any courses in finance, I'm quite sure you have come across about the fat tail risk or the risk of extreme event and the losses that someone would incur because of that. And so I'll you know discuss a bit about that and why that's such an important topic of discussion in the field of finance, not just in the field of quant finance, but in all areas of finance, and how that is mitigated, how that is modeled, how that is it is you have mitigations in place through risk management practices, and what are the controversy around fat tail risk, and it's an academic topic, but it's also often highly criticized topic, and the biggest critic for the academic ideas to account for fat tail risk comes from Nassim Taleb. If you have heard about him, I don't know, I think you probably have heard about Nassim Taleb, right? uh, he has written a book, Black Swan, and he has written many good books in the field of finance. So, if you want to read his book, welcome. He is a controversial man. His views about traditional statistical modeling is a bit controversial. In fact, very controversial. A lot of professors of statistics have criticized him. He himself is a professor, by the way. He is teaching in University of Newark, I think. Right. So he has discussed about the fatal risk in his book Black Swan, right? Extreme risk and that what that could mean for portfolios, right? So whether on the lending side or on the trading side, fatal risk is something to be taken into account, and the portfolio managers are required to think about that, and how do they handle such extreme events and what mitigations are in place, and what would be the potential consequence if something that of that happens. Now, as you see on the screen, right, if you if you plot the return distribution, it's could be normally distributed, but not always normally distributed. In some cases, you will see that you have extreme losses. Um, Chances of that happening is very very low. So the probability of that may be 0.00 something like that, very small. But you could encounter extreme events. Extreme events, what does that mean? It could be a financial crisis, the 2008 financial crisis, an extreme event. The global financial crisis, corona is an extreme event, right? The COVID-19 2020 crash is an extreme event. The dot-com boom and the bust, right? The internet bust of 2000 2001, right? The Asian financial crisis. These are extreme events where one could go pretty wrong, and there will be a massive loss, especially for people who have taken short-term positions. Those who have taken long-term positions, okay, the market recovers, it takes time. Short-term losses, mark-to-market losses, not realized losses, but okay, things will get better. But if traders have taken short-term positions, then things can go wrong. That's on the trading side, but also on the lending side, this is an issue, right? On the lending side, you have concentration on few of the clients, and some of these large clients default. You see a sudden drop in the profit, or maybe a massive loss for the bank, right? That's an extreme event. And if you do the distribution, the probability of that happening is very very small. But if that happens, if at all that happens, then it can wipe out a lot of the profit that you have made over the last many years, right? And the criticism from Nassim Taleb and many, I think perhaps from him, not unless from others, is that this is not accounted for correctly. I mean, there is higher chances, higher risk of happening that. The probability is not that low as it is, perceived in the field of quantitative analysis in the field of financial markets. And what Nasir Taleb thinks is that it's something that should not be ignored. People ignore it because the probability of that happening is quite low, and hence people say, "Oh, so we don't care." But the way you measure the probability is through traditional statistics. Okay, for example, the value at risk model, something that Nassim Taleb absolutely hates. In fact, many quants don't like value at risk models, but it has come from the world of academia, published papers. People have got Nobel Prize, so you can't criticize. But there are inherent problems with such use of traditional statistic in the field of finance, where the calculations could potentially go wrong in some situations, um, and we have seen that happening in 2008 financial crisis, where many organizations went bankrupt, both on the lending side but also on the trading side. Not just that, even on insurance side as well. Some insurance company also went bankrupt, right? And mortgage company like Fannie Mae and Freddie Mac went bankrupt. Lehman Brothers as well, but also many trading firms who had short-term positions. They simply did not anticipate something to happen like that. Completely wiped out from the market, had to shut down uh, the company. Right. So, what are the ways to sort of account for that? Right. One way is, you probably have heard about value at risk model is now replaced with another form of value at risk, which is the expected shortfall, which is somewhat different and takes care of a bit of the fat tail risk, or the risk stemming from extreme events. Again, bit controversial. Many quants don't agree with the view, but the regulators have made changes to account for short-term, to account for the extreme events and the risk coming from, or the losses coming from extreme events. So that's one way that uh, it's model. Um, there are many other ways, by the way. Okay. One thing being that some people take, I mean, main trading firms take derivative positions. Actually, they mitigate through derivative positions, and they buy derivative. They go for options. They buy options. That's one. Uh, that the risk mitigation. On the lending side, also, many banks buy insurance, and they also have derivative position as well. But even insurance against fraud risk, insurance against collateral damage, and so on and so forth. Okay, so that's done business wise. In terms of using mathematical models, as I've said, value at risk has been adjusted a bit more recently. On the lending side, um, the regulators have come up with various risk management uh, techniques to account for such risk, such as you know um, what the conservative capital measures, capital level. That doesn't solve everything, you know, but it's just that even the event of such something like happening, which is you have completely unexpected losses, that's still accounted for in the capital. So that's already part of it. So that's one way of mitigating the risk out of it. Um, Now, as a someone who is working in risk management, you should be really concerned about the tail risk, and you should therefore come up with strategy as to how to mitigate the tail risk. Okay, mathematically or otherwise, it can be mitigated by the business folks who do business, for example, buying insurance, having derivative positions, and so on. Or it can also be done to some extent through best practice, risk management best practice. It could also be done through models, right? And taking conservative approaches as and when needed. It will never be able to mitigate tail risk completely, but it can certainly be mitigated to some extent. Okay. In fact, modeling wise, right, there is a particular type of statistics called statistic for extreme observation, extreme events or extreme observation. Extreme value theory is one such statistical modeling technique that is used, right? Simulations techniques are also used to see the potential chances or the probabilities of any extreme event happening in the future, right? So Monte Carlo simulation techniques are also used. Okay, thanks, guys.